The market has a funny way of telling you that you're wrong.
It really does.
Usually it's a polite tap on the shoulder, a bad earnings report, a slight dip in a trend line.
Something that gives you time to react.
Exactly. You get a few weeks, you can adjust your positions, rethink things, maybe exit gracefully. But what we witnessed recently, that was not a tap on the shoulder.
No, that was a brick to the face.
A full-on brick to the face.
It was a violent repricing of reality.
Yeah.
We are talking about billions, literally billions of dollars in sure thing positions just evaporating in a matter of hours.
It was one of those moments where you could actually see the narrative break, like in real time on the screen.
You could, yeah, a total paradigm shift.
So that's what we're digging into today. We're looking at the file on the Warsh effect. This is our deep dive into the nomination of Kevin Warsh to replace Jerome Powell as chairman of the Federal Reserve in 2026.
And this is not just about the politics.
No, not at all. I mean, the politics are interesting, sure, but the mechanics.
Yeah.
The mechanics are fascinating. We're looking at a collision. It's a collision between an unstoppable force, the national debt, and what the market now sees as an immovable object, Kevin Warsh's philosophy.
That is the perfect way to frame it. It's a collision, and the wreckage from that collision is what we're seeing all over the charts for gold, silver, and of course the US dollar.
Okay, so let's set the scene before the crash. Because to really understand why everyone panicked, you have to understand the party they were all at beforehand.
Right.
So take us back just a few weeks. What was the market consensus? What was the smart money doing? What was the trade?
The trade was the one-way street. That's what they were calling it.
A one-way street.
Yep. If you walked into any hedge fund in New York, any macro strategist's office in London, the consensus was absolute. It was lockstep. You bet against the United States dollar.
Short the dollar, long everything else.
That was it. And everything else specifically meant hard assets.
Gold, silver, Bitcoin, the inflation hedges.
Exactly. The logic was,
Yeah.
it was incredibly seductive because it seemed so simple.
Flawless, even.
Almost. The narrative went like this. The United States government is, addicted to spending. The deficit is running at emergency levels, but we're not in an emergency.
Right, the economy is supposedly doing fine.
And the national debt is just compounding, getting bigger every second.
Yeah.
And on top of all that, you have Donald Trump, who has been very vocal about wanting more stimulus. He wants growth. He wants to rebuild things.
That's his whole persona, right? The builder president. He wants low rates for real estate. He wants a weaker, more competitive currency to help with exports.
Correct. So the market algorithms, the big funds, they took all those inputs, high debt, high spending, a pro-growth president. And the output was just one thing, the debasement trade.
The debasement trade, meaning the value of the dollar was set to go down.
Drastically. The core assumption was that the Federal Reserve, regardless of who was actually sitting in the chair, would eventually have to give in to something called fiscal dominance.
Let's unpack that term. Fiscal dominance. It sounds like a heavy metal band.
It might as well be.
Yeah.
It's the absolute nightmare scenario for a central banker. Fiscal dominance is the point where the government's debt gets so big that the central bank, the Fed, loses its independence.
It can't do its job anymore.
It can't. The Fed can no longer set interest rates to, say, manage inflation. Instead, its primary job becomes keeping the government from going bankrupt. It must keep interest rates low and print money to buy government bonds, because if it doesn't,
The whole house of cards comes down.
the government defaults. So the fiscal policy, the spending decided by Congress, it dominates the monetary policy of the Fed.
So the Fed becomes a hostage.
A hostage to the Treasury. And the market was betting that the hostage situation was already here. They believed the Fed would have no choice but to print trillions of new dollars to monetize the debt.
Which is just a fancy way of saying they'd print money to pay the bills.
Exactly. And if you print trillions and trillions of dollars, the value of each individual dollar, it collapses.
And if the dollar collapses, the price of gold, which is priced in those dollars, goes to the moon.
That was it. That was the hyperinflation trade. Investors were just piling into gold, silver, crypto,
Right.
expecting a straight line up. They were leveraged up to their eyeballs. They were confident. It felt like free money.
It really did. You just buy the shiny metal and wait for the printer to go brr.
Total euphoria. I mean, the headlines were calling for $3,000 gold, $200,000 Bitcoin. It wasn't a question of if, just a question of when.
And then the notification hit the wires.
The trigger event.
A news alert pops up on the Bloomberg terminal. Donald Trump nominates Kevin Warsh. Now, a Fed nomination is usually sleepy news, right? It's for the policy nerds. Why was this specific name the pin that popped that entire balloon?
Because Kevin Warsh is the anti-narrative. He is the polar opposite of what the market had priced in.
Okay.
The market priced in a dove, someone who would play along, print the money, keep the party going, and Kevin Warsh is not a dove.
And the reaction was just instantaneous. Describe the carnage for us.
It was a classic liquidity flush, a panic.
Hmm.
Gold didn't just drift lower, it crashed. It fell off a cliff.
Then silver.
Silver's like gold's high beta cousin, so it just collapsed. And the U.S. dollar, the very asset everyone was shorting, the currency that was supposedly on its deathbed, it spiked vertically. It was a massive, massive short squeeze.
Unbelievable. So that is our mission for this deep dive. We need to decode the Warsh effect. We've got 3 big questions we need to answer.
Yeah.
First, who is this guy and why does he scare the gold bugs so much? Second, we have to tackle the strategic paradox here. Why would Trump nominate a guy who seems to stand against everything he wants economically?
The 4D chess move.
Right. And third, and this is the most important one, the reality check. Did the math actually change, or is this all just a temporary shift in sentiment?
That's the trillion-dollar question, isn't it? Are we looking at a cure for the disease or just a very powerful painkiller?
Let's start with section 1 then. The man, who is Kevin Warsh. Because he's not a newcomer. He's not some obscure academic pulled out of a university lounge.
No, and that's a really crucial distinction here. Most Fed chairs, they're PhD economists. They spend their entire lives writing academic papers about theoretical models.
Right.
Warsh is different. He came from Wall Street. He was at Morgan Stanley. And, most importantly, he was a governor at the Federal Reserve during the 2008 financial crisis. He has battle scars.
So he was in the room when the entire global financial system almost came to an end?
He was in the room. And his reputation from that era is very, very specific. See, in the Fed, there's a tremendous amount of institutional pressure to conform. Groupthink is a huge problem in central banking.
Everyone wants to agree with the chairman.
Dissent is extremely rare. But Warsh is remembered as the skeptic. He was the guy questioning things when everyone else was nodding along.
The one raising his hand in the back of the class.
Specifically, he was raising his hand about quantitative easing, QE.
We hear QE all the time. Let's just make sure we're all on the same page. It's essentially the Fed creating new money to buy bonds, injecting cash into the system.
That's it. The Fed creates money electronically, literally out of thin air, and uses it to buy securities, mostly government bonds, from banks.
Right.
This floods the banking system with reserves, which is supposed to lower long-term interest rates and encourage risk-taking.
And back in 2008, 2009, this was seen as the only thing that could save the world.
It was the bazooka, the savior mechanism. But Warsh wasn't fully convinced.
So he was against the initial bailouts?
No, to be clear, he supported the initial emergency measures to stop the immediate panic. But as QE1 became QE2 and then QE3, as it dragged on for years, he became a very vocal critic.
What was his argument?
His core philosophy is simple.
Yeah.
You cannot print your way to prosperity. He believes that easy money, artificially low interest rates, and endless money printing, it just distorts the economy, creates bubbles, it rewards bad behavior, and punishes savers.
He believes in market discipline.
He believes that capitalism requires failure. It needs creative destruction. If you take away the risk of failure by printing money every time the stock market drops 10%, you aren't practicing capitalism anymore. You're practicing some weird form of state-managed speculation.
There was this one visual analogy one of our sources used to describe him that I thought was perfect. The party analogy.
Oh, the punch bowl. Yes, it's the perfect visualization.
So lay it out. Imagine the economy is a massive party.
A rager. A complete blowout. The music is thumping, people are dancing on the tables, and in the center of the room is this giant crystal punch bowl.
And the punch in that bowl is liquidity. It's cheap debt, easy money.
Exactly. Now, usually the Fed governors are the ones with the ladles. They're pouring in more vodka, more sugar, making sure the vibe stays high. The unspoken mandate is keep the party going.
Don't let the music stop. But then Kevin Warsh walks in.
Right. He walks in wearing a sharp suit, looking very serious. He walks straight up to that punch bowl, pushes the other governors aside, crosses his arms, and just starts pouring in ice water.
He's the ultimate buzzkill.
He's the buzzkill. But in his mind, he's the adult in the room. He's the designated driver. He's the one saying, look, you've all had way too much. If you keep drinking this cheap credit, you're going to get alcohol poisoning. We need to sober up.
And sobering up in economic terms means what?
It means higher interest rates. It means a stronger dollar. It means withdrawing liquidity from the system. It means that the asset bubbles in stocks, in real estate, in gold, they might have to deflate painfully.
Which is a terrifying prospect for Wall Street. I mean, they've been drunk on that punch for the better part of 15 years.
Which is exactly why they call him a hawk.
Okay, let's nail down these terms. Hawk versus dove. They get thrown around like sports team names, but the distinction is critical.
It all comes down to priorities. What does the central banker care about most? A dove prioritizes employment and economic growth. They're soft. They worry that raising interest rates will hurt workers and cause a recession.
So they'll tolerate a little more inflation to keep people employed.
Exactly. They'll err on the side of inflation. They'd rather have prices go up a little bit than have people lose their jobs. Jerome Powell, for the most part, has been seen as a dove, or at least the market has forced him into that role.
And a hawk?
A hawk is a predator. A hawk's #1 priority is the currency, the integrity of the money. They view inflation as a moral failing, as a theft from the people, especially from savers.
So they're willing to inflict pain to stop it.
A hawk is willing to inflict a lot of pain.
Yeah.
A recession, job losses, stock market crash. If that's the price you have to pay to preserve the long-term value of the dollar, a true hawk is willing to pay it. Think Paul Volcker in the early 80s.
So Warsh is the ultimate hawk. The market sees him as the hard money candidate.
The guy who believes the dollar should be as good as gold. He's not there to pump the stock market. He's there to protect the currency.
This helps explain the algorithmic reaction so much better, because we live in a world where machines trade faster than humans can even think. When that news broke, it wasn't some guy at a desk making a phone call. It was just code executing.
It was pure if-then logic. The computers were programmed with a very simple logic tree. Before the announcement, it looked like this. If the national debt is high and the government wants stimulus, then the Fed will monetize the debt.
And the result of that logic is?
Buy gold. Sell dollars. It was a simple bet on the printing press.
But the moment the name Warsh hits the Bloomberg terminal, a key variable in that equation just changes.
Instantly. The logic shifts to, if Kevin Warsh is the Fed chair, then the Fed will refuse to monetize the debt.
He won't turn on the printer.
He won't. He'll fight it tooth and nail. And if the supply of new dollars isn't going to explode higher, then the existing dollars become more scarce, more valuable. So the algorithm's output flips.
Buy dollars, sell gold.
It's just that binary. It's like flipping a switch from black to white.
It's amazing. One of the newsletters we read described it with this sort of noir visual that I found really compelling.
Oh, the poker table.
Yeah, the poker table. Picture a smoky backroom poker game. The table is piled high with chips. And these chips, they represent all the easy money bets, all the speculation on runaway inflation.
The debasement trade.
Right.
Everyone is all in.
Right. And then a hand reaches into the frame, a very well-manicured hand, crisp French cuff, that's Warsh, and in one single violent motion, he just sweeps all the chips off the table. They go flying everywhere.
The game's over.
The game is over. And in the center of the now empty green felt, he places a single heavy metal card, and etched into it are 2 words, hard money.
That really captures the violence of the move, doesn't it? It wasn't a gentle adjustment. It was a complete clearing of the deck.
And then that leads us directly into our second section, the mechanics of the crash. Because we need to explain why the price action was so brutal. Why did gold collapse hundreds of dollars in a blink? It wasn't just a slow sell-off.
No, if people had just changed their minds, you'd see a gradual decline over days or weeks. This was a cliff dive.
So why the cliff dive?
To understand it, you have to understand 2 words. Positioning and leverage.
You're talking about the fast money.
Exactly. In the weeks leading up to this, that gold trade had become incredibly crowded. It wasn't just the long-term believers in gold anymore. It was the tourists.
The people who show up late to the party?
The retail traders using apps, the momentum-chasing algorithms, the CTAs, the commodity trading advisors. They just saw the price going up. So they bought. They were chasing the breakout.
And crucially, they were doing it with leverage.
Massive leverage. They were borrowing money to make even bigger bets on gold. So let's use a simple example. Let's say you put down $10 of your own money to control $100 worth of gold. That's 10-to-1 leverage.
Okay.
If gold goes up 10%, from 100 to 110, you've made $10, but you only put up $10. So you've doubled your money. You made 100% return.
That's the seduction of leverage.
That's the seduction. But here's the dark side. If gold goes down 10%, from 100 to $90,
You've lost $10, which was all the money you put up.
you're wiped out. Your position goes to 0. And here's the mechanism of the crash. When the Warsh news hit, the dollar spiked and gold dropped. Let's say it dropped just 2% initially.
Okay, not a disaster.
Not for an unleveraged holder, but for the guy with 10-to-1 leverage, a 2% drop is a 20% loss. That 2% drop was enough to trigger the stop losses of the most highly leveraged traders.
So their brokers automatically sold their positions to prevent any more losses, a margin call.
Exactly. The computer just sells the gold to cover the loan. But here's the problem. That forced selling pushes the price of gold down another 2%, which then triggers the next wave of stop losses from slightly less leveraged traders.
It's a domino effect, a chain reaction.
It's a liquidation cascade.
Yeah.
Panic selling begets more panic selling. The Warsh effect was the pin, but the balloon was already overinflated with speculative leverage. All the tourists got flushed out in a matter of minutes.
There's another layer to this too, a psychological one that goes beyond just the leverage. And that's the concept of the Fed put. I mean, I've heard this term for 20 years. Don't fight the Fed, and the Fed has your back.
The Fed put is the market security blanket. It's the belief, learned over decades of conditioning, that if the stock market drops too much, say 20%, the Federal Reserve will step in to save it.
They'll do whatever it takes.
They'll cut rates. They'll launch a new QE program. They'll flood the system with liquidity to prop up asset prices.
It's like bowling with the bumpers up in the gutters. You can't really lose. You can't throw a gutter ball.
That is a perfect analogy. Investors have been trained like Pavlov's dogs. Market crashes. Fed prints money. So what do? You buy the dip. Every single time. But Warsh represents the removal of the bumpers.
He's the guy who might look at a 20% market crash and say, good, you all needed that. A little discipline.
He fundamentally believes in creative destruction. He thinks recessions are a natural and necessary part of the economic cycle. They're like a forest fire that clears out all the dead brush and weak companies so that new, healthy trees can grow.
And if you keep putting out every small forest fire?
Eventually, the fuel builds up so much that you get a catastrophic inferno that burns the whole forest down.
So the market looked at the Warsh nomination and had this sudden, terrifying realization the safety net might be gone.
The security blanket is gone.
Huh.
And that realization caused a massive, instantaneous repricing of risk across the board. If the Fed isn't going to save you anymore, then suddenly holding risky assets doesn't look so attractive.
And holding cash, holding the US dollar, suddenly looks very, very safe.
So it wasn't necessarily that everyone suddenly hated gold's long-term story. It was that they suddenly loved the dollar's short-term survival story.
It was a celebration of the dollar. The market basically said, okay, the dollar isn't going to die after all. The adults are back in charge.
Yeah.
This brings us to what might be the most confusing part of this whole puzzle. Section 3, the Trump paradox.
This is where it gets really interesting from a strategic perspective.
Because on paper, it makes absolutely no sense. Donald Trump is the low-rate guy. He has publicly screamed at Fed chairs in the past, including his own appointee, Jerome Powell, for not lowering REITs fast enough.
He wants the rocket ship economy. That's his phrase.
A weaker dollar to help American manufacturing, low rates to help real estate and construction. He wants the economy to run hot, hot, hot. So why, in the name of all that is holy, does he nominate Kevin Warsh?
The hard money hog.
The guy who is philosophically opposed to everything Trump seems to want from the economy. It's like hiring a vegan to run a steakhouse.
It absolutely feels like a contradiction, a massive one. But this is where you have to, step back and look at the strategic thinking here. The smart money view is that this is a brilliant play, for one thing. Credibility.
Credibility with who? Not with his base who wants a booming stock market.
No. Credibility with the bond vigilantes.
Okay, stop right there. Bond vigilantes. That is the coolest, most intimidating name in all of finance. Who are these people? Are they guys in trench coats and fedoras?
I wish they were. No, they're far more terrifying than that. The bond vigilantes aren't a specific group of people. They're the collective, anonymous power of the global bond market.
So we're talking about the sovereign wealth funds in the Middle East, the massive pension funds in Europe, the Japanese insurance companies.
The People's Bank of China. Exactly. It's the massive pools of capital that buy U.S. Treasury debt. They are the people who lend America money.
And they have the power to destroy a presidency.
They absolutely do. You have to remember that famous quote from James Carville, Bill Clinton's political advisor. He said, "I used to think that if there was reincarnation, I wanted to come back as the president or the pope or a .400 baseball hitter, but now I would like to come back as the bond market." You can intimidate everybody.
Because if the bond market simply stops buying your debt,
Your interest rates explode. Your country goes broke.
walk us through that nightmare scenario for a president.
Okay, so imagine the bond market loses trust in the U.S. They look at Trump's spending plans, they hear the talk about stimulus, and they think he's going to spend trillions, he's going to cause massive inflation, the value of our bonds is going to get crushed.
So they go on strike, they stop buying U.S. treasuries at the auctions.
They stop buying, or they demand a much higher interest rate to compensate for the risk. The yield, the interest rate the U.S. has to pay to borrow it spikes. The 10-year Treasury yield goes from 4% to 6% to 8%, maybe even 10%.
And because basically every other interest rate in the world is priced off the 10-year Treasury.
It's game over. Mortgage rates hit 12%,
Yeah.
car loans hit 15%, corporate borrowing costs go through the roof, companies stop investing and start laying people off, the stock market crashes, the economy grinds to a halt. It's called a bond market riot.
And if that happens, Trump's presidency is over before it even starts. He can't do his tax cuts. He can't do his infrastructure projects. He can't do anything if the country's financing window is slammed shut.
He knows this. His advisors know this. He knows the national debt is the Achilles heel of his administration. The debt is so high now, we're talking over $38 trillion, that the bond market is on a hair trigger. They are nervous.
So Warsh is the sedative. He's the signal to the bond market to calm down.
Warsh is the sedative, or a better analogy might be the bridge.
Okay, explain the bridge analogy.
Imagine Trump is trying to get to his legacy, right? His legacy of growth and prosperity. And to get there, he has to cross this massive gaping chasm.
Okay.
But the only bridge across this chasm is made of paper. It's the U.S. dollar. And underneath that flimsy paper bridge is a fiery pit called bond market collapse.
And that paper bridge is getting shaky because of the weight of all the debt.
It's rotting. It's unstable. Everyone knows it. So how do you get across? You have to reinforce that bridge with steel beams. Kevin Warsh is the steel.
So by nominating a famous hawk, Trump is sending a direct message to the bond market. He's telling them, relax.
He's saying, look, I know you're worried about inflation. I know you're worried about our debt. But look who I just put in charge of the money. I put the toughest, most credible, hard money guy in the world in that seat. He won't let things get out of control.
It buys him trust. It buys him time.
It buys him the benefit of the doubt. The bond vigilantes look at Warsh and they say, okay, Kevin won't let inflation run wild. He'll keep the dollar sound. We can keep buying U.S. bonds for now.
So yields stay stable, the dollar strengthens, and Trump gets the political space to pursue his other policies.
It's a brilliant, almost Machiavellian move. He sacrifices his short-term desire for super low rates in order to ensure the long-term survival of the system he needs to operate in. He's intentionally creating a tug of war.
A tug of war between himself and his own Fed chair. Trump pulling for stimulus, Warsh pulling for discipline.
And the market loves that tension because it implies balance. It implies that neither side will go to a crazy extreme. If Trump had just appointed a yes man, some dove who would do whatever he said, the bond market would have puked. They would have sold everything, fearing hyperinflation was guaranteed.
So by picking his own opponent, in a way, he bought an insurance policy against a currency crisis.
That is the smart money read on this. It's 4D chess.
But, and this is the biggest but of the entire deep dive, insurance policies have limits. Narratives are powerful, sentiment is powerful, but eventually you run headfirst into the hard, cold, unyielding concrete of math.
And the math at this point is just ugly.
Which brings us to Section 4, the reality check. We've had the panic, we've had the nomination, the dollar is strong. But has anything actually changed in the engine room of the economy?
No. And that's the forensic twist, as one analyst put it. The crime scene hasn't changed at all. We just have a new, very famous detective on the case.
So let's go down the checklist. Has the national debt disappeared?
Not a single penny of it.
Has the annual government deficit vanished?
Nope. Still in the trillions.
Give us the number. What is the size of the mountain that Kevin Warsh is now expected to move?
We are looking at roughly $38.5 trillion in national debt. And that number is so large that the human brain can't really process what it means.
So try to contextualize it for us. Break it down.
Okay. The interest payments alone, this isn't paying down the debt, this is just paying the interest on the debt, is now over $1 trillion a year.
Wait, say that again? We are spending more on interest payments than we spend on the entire U.S. military.
Yes. We are spending more on interest now than on Medicare. It is about to become the single biggest line item in the entire federal budget.
That is absolutely staggering. And this is where we have to talk about the limits of Kevin Warsh's power. He might be a hawk, but he isn't a magician. He is one man.
He is one man with one main tool, the federal funds rate, interest rates. He does not control Congress, so he can't stop them from spending money. He does not control the IRS, so he can't raise taxes.
He can only control the price of money.
And this reality creates what some are calling the ethical dilemma, but what I think is more accurately described as the mathematical trap for a hawk like Warsh.
Okay, walk us through this trap, step by step.
All right, so Warsh's entire philosophy, his entire reputation is built on sound money. He wants to keep interest rates high enough to kill inflation and protect the value of the dollar. Let's call that option A.
Sounds responsible. Sounds like what a Fed chair should do.
It is responsible, but here's the catch-22. If interest rates stay high, let's say at 5% or 6%, where they are now, then the annual interest bill on that $38 trillion of debt becomes catastrophically unpayable.
What do you mean unpayable?
The U.S. government literally cannot collect enough tax revenue to pay the interest on its own debt. You'd have to borrow more money just to make the interest payments.
That's a classic debt spiral. You're using one credit card to pay off the minimum payment on another credit card.
It's the definition of a debt spiral. And if Warsh keeps rates high to save the dollar, he might end up bankrupting the U.S. Treasury. He would force a sovereign debt crisis, a default, or a massive austerity crisis, where the government has to slash Social Security, slash the military, just to pay the bondholders.
Which would trigger an event on the scale of the Great Depression.
Absolutely. So in an attempt to save the dollar, he ends up destroying the U.S. economy. That's option A.
Okay, so option A sounds terrible. What's option B?
Option B is the thing we talked about earlier, fiscal dominance. The debt is just so overwhelmingly large that the Fed is forced to capitulate. Even though Kevin Warsh hates it with every fiber of his being, even though he's a hawk, the math forces him to become a dove.
He's forced to lower interest rates and turn the printer back on.
Yes, because it's the only way to keep the government solvent. It's the only way to make sure the Treasury checks don't bounce. He has to devalue the currency to inflate away the debt in order to save the system from collapsing under its own weight.
So he might be a hawk in his heart, but the math on the spreadsheet in front of him might force him to act like a dove in practice.
That is the terrifying realization that the truly smart money is starting to whisper about. Now that the initial panic is over, they're asking the question, can he actually do it? When push comes to shove, can he actually stand firm against the full weight of the Treasury?
Imagine that phone call. The Treasury Secretary calls up Fed Chair Warsh and says, Kevin, we have a bond auction tomorrow for $1 trillion. And right now, there aren't enough buyers. If you don't step in and buy the bonds with newly printed money, the United States government will default on its debt for the first time in history. On your watch.
What does he do? Does he let the U.S. default? Does he let the global financial system implode on his watch? Probably not. He prints the money.
So the Warsh effect might just be a bluff.
I don't think it's a bluff. I think it's a valiant, principled effort. But it's an effort that's fighting against the laws of financial gravity. You can't fight exponential math with philosophy forever.
Which brings us, finally, to Section 5, the verdict. We've seen the crash, we've analyzed the man, we've looked at the mathematical trap. So what does this all mean for you, the listener, right now? How should we be viewing this new reality?
I think the best way to frame the immediate situation is as a repricing of confidence.
A repricing of confidence.
Yes. The market went from a state of near certainty, fearing an imminent dollar collapse, to a new state of belief in a credible dollar defense. And that shift in confidence is real. It's powerful. And in the short term, let's say the next 6, 12, maybe even 18 months, it gives the dollar legs.
So the hyperinflation trade is on pause. Buying gold and just waiting for the moonshot. That's off the table for now.
It's definitely on pause. The dollar is, as they say, the cleanest shirt in the dirty laundry basket right now, and its guardian just got a lot tougher.
But what about the long-term holders, the people who bought gold not to speculate, but because they are genuinely worried about that $38 trillion number? What does this mean for them?
This is where we get to the speed bump theory.
Okay, I like this imagery.
The really sophisticated investors, the ones who study economic history, the central banks, they view Kevin Warsh as a very large, very well-respected speed bump. But he's a speed bump, not a brick wall.
He can slow the car down, but he can't stop it.
He can absolutely slow down the debasement. He can make it harder to get easy money. He can enforce a period of discipline. But he cannot stop the car.
Because the car is being driven by the mathematical certainty of that $38 trillion debt pile.
Exactly. The final destination of the car hasn't changed. The United States government eventually must devalue its currency to deal with that debt. There is simply no other mathematical way out. We can't tax our way out of it, and we can't grow our way out of it fast enough.
So we have to inflate our way out.
We have to. It's the historical playbook for every reserve currency empire in history. So what Warsh does is he slows the process down. He makes it more orderly. Instead of a chaotic hyperinflationary crash, maybe we get a more controlled devaluation over the next decade.
So if you were a fast money tourist, you panicked and you sold your gold at the bottom. But what is the smart money, the really long-term players doing right now?
And this is the most fascinating part of the whole story. While the retail investors and leveraged funds are panic selling, who is on the other side of that trade? Who is buying?
Who?
The central banks of the world. China, India, Poland, Singapore. Their official data shows they're buying physical gold hand over fist on this price drop.
They're buying the dip.
They are quietly accumulating. They're using this Warsh-induced panic and price drop to pick up hard assets at a discount because they are playing the long game. They know that eventually the mathematical trap closes and the printer has to be turned back on.
So it's a game of chicken between sentiment and math, and right now, Warsh's hawkish sentiment is winning.
But math always plays the long game, and math always wins in the end.
Okay, so to summarize for everyone listening, the dollar has a new, credible guardian. The market respects him, maybe even fears him. The short-term speculators got completely flushed out. But the underlying problem, the $38.5 trillion elephant, is still sitting in the middle of the room, eating peanuts.
And it is getting bigger and hungrier every single day.
Before we wrap this up, I want to leave everyone with one final image. You mentioned Cass earlier, and I think that's the perfect way to close this.
Yes. This whole strategic situation, Trump, Warsh, the debt, it reminds me of a very specific position in a high-stakes chess match.
So set the scene for us.
Okay, imagine a grandmaster. He's looking down at the board, and his position is messy. It's not good. His opponent, let's call the opponent the inevitable debt spiral, is swarming his defenses. The king, which represents the U.S. economy, is exposed and vulnerable.
It looks like checkmate is only a few moves away.
It does. The situation looks dire. So the grandmaster makes a move, a decisive move. He picks up his knight, a powerful, versatile piece, that's Kevin Warsh, and he moves it into a strong central defensive position.
Okay.
The knight now blocks an attacking pawn. It threatens the enemy's bishop. It changes the entire feel of the board. It looks aggressive. It looks strong.
The crowd watching the match probably cheers. They think he's just turned the whole game around.
They do. But the grandmaster himself isn't smiling. After he makes the move, he leans back in his chair and quietly shakes his head.
Why? Why isn't he happy with his own move?
Because he knows the deeper truth of the board. He knows that while the knight is a brilliant defensive piece, the rest of his pieces are still pinned down. He knows the fundamental geometric weakness of his position hasn't actually changed. He has bought himself 5 more moves, maybe 10.
It's a stalling tactic.
It's a brilliant stalling tactic, a masterful one even. And he hasn't stopped the checkmate. He's only delayed it.
And that is the provocative thought we want to leave you with today. Can one man, no matter how principled or hawkish, actually stop the mathematical inevitability of a debt spiral this large? Or is Kevin Warsh just the most credible, most expensive speed bump in economic history?
That is the question that is going to define the next 4 years, not just for the U.S., but for the entire global economy.
So we want to hear from you. What do you think? Do you believe the dollar is saved? Or is this just the eye of the storm before the real crisis hits?
Watch the bond yields. Don't listen to the commentary. Just watch the bond yields. That's where the truth will show up first.
Keep your eyes on the charts and keep your eyes on the Fed. Thanks for joining us for this deep dive.
Watch the Fed.